Did the bubble burst? The reality about today's shooting star candle. Today, a single candlestick appeared on the charts, the kind Wall Street veterans fear most, the shooting star. It's shown up only twice in the last 20 years. 2000, right before the dot-com collapse. 2008, days before Lehman Brothers fell. And now, it's back. But here's what they're not telling you. The numbers behind this signal are far worse than both those times combined. Your portfolio, your business, your retirement, everything could change in the next 72 hours. And most people have no idea what's coming. Welcome to Financial Inspection. Now, if you're someone who values your hard-earned money, someone who's spent decades building wealth, brick by brick, then do me a favor, hit that subscribe button right there. Think of it as locking the door before the storm hits. And tell me, where are you watching this from today? Are you in the States, UK, India, Singapore? Drop your location in the comments, because what I'm about to show you affects every single market, everywhere. Let's begin. March 15th, 2000. A trader named Michael sat in his office on the 42nd floor of a Manhattan skyscraper. He watched his screen as the NASDAQ formed a pattern, a single candlestick, long upper shadow, tiny body, almost no lower tail, a shooting star. Michael had seen this pattern only twice before in his career. Both times, the market collapsed within weeks. He picked up the phone. He called his biggest clients. He told them to sell. Most of them laughed. The market had been rising for years. Technology stocks were the future. Everyone said so. 6 weeks later, those same clients lost 40% of their wealth. Fast forward to October 2008. Sarah, a portfolio manager in London, spotted the same pattern, this time on the S&P 500. The shooting star appeared on a Monday morning. She immediately reduced her fund's exposure to equities. Her colleagues called her paranoid. The Federal Reserve had just bailed out Bear Stearns. Everything was under control, they said. Lehman Brothers collapsed 12 days later. Today, that exact same pattern appeared again, but this time, something is different, something far more dangerous. The shooting star is a technical formation that appears when a market opens, rallies aggressively during the trading session, then collapses back down to close near its opening price. It leaves behind a long upper shadow. That shadow represents rejected higher prices. It means buyers tried to push the market up, but sellers overwhelmed them. It's a rejection, a reversal signal, a warning. In technical analysis, this pattern carries weight only when it appears at specific moments. It must form after a prolonged uptrend. It must occur at or near all-time highs, and it must appear when market valuations are stretched beyond historical norms. All three conditions exist right now. The S&P 500 has risen for nearly 2 years with minimal corrections. Major indices sit within percentage points of record highs, and the valuations tell a story that most investors are choosing to ignore. The Shiller price-to-earnings ratio currently stands at 34.7. That number measures how expensive stocks are relative to their 10-year average earnings. For context, the historical average is 17. During the dot-com bubble peak, it reached 44. Before the 2008 crash, it hit 27. Right now, at 34.7, the market is more expensive than it was before every major crash in history except one. But the shooting star alone isn't the problem. It's what that candlestick represents. It's the symptom of something deeper, something systemic. Think of it this way. When a doctor sees a patient with a persistent cough, the cough itself isn't the disease. It's a signal. It indicates pneumonia or bronchitis or something worse. The symptom points to the underlying condition. The shooting star is that cough. And the underlying condition is a market built on a foundation that's crumbling. For the past 15 years, central banks have injected more than $20 trillion into the global financial system. They've suppressed interest rates to zero, in some countries below zero. They've purchased government bonds, corporate bonds, even stocks in some cases, all to keep asset prices rising. This created an environment where money became free, where companies could borrow at almost no cost, where investors were forced out of safe assets like savings accounts and bonds, and pushed into riskier assets like stocks and real estate. The result? Asset prices disconnected from reality. Companies with no profits trade at billion-dollar valuations. Real estate in major cities costs 50 times the average worker's annual income. Margin debt, money borrowed to buy stocks, has reached all-time record levels, and now, today, the shooting star appears. It's telling us that the buyers are exhausted, that the momentum is fading, that the weight of overvaluation is finally becoming too heavy to sustain. Michael in 2000 saw it. Sarah in 2008 saw it. And now, this pattern has returned for the third time in a generation. But here's what makes this moment different. This time, central banks have already used all their ammunition. Interest rates are already near zero. Balance sheets are already bloated. Fiscal deficits are already at wartime levels. When the collapse comes this time, there's no safety net left. The question isn't whether the bubble exists. The data confirms it does. The question is whether today's shooting star marks the beginning of the end. The answer is hidden in the details, in the yow. There's a story that few people know. In 1636, a single tulip bulb in Amsterdam sold for the price of a large mansion. Not a bouquet, not a garden full of flowers. One bulb, one seed that would grow one flower. The buyer wasn't insane, he was rational, because the day before, someone else had paid slightly less. And the day before that, someone paid even less. The price kept rising, so buying made perfect sense. Until February 1637, when it didn't. One Tuesday morning, a buyer at an auction refused to bid, then another refused. Within 3 days, tulip prices collapsed by 99%. Fortunes evaporated. Families lost everything. The first recorded speculative bubble in history had burst. But here's the critical detail most people miss about tulip mania. The tulips themselves didn't change. They were the same flowers in February that they were in January. Same petals, same colors, same fragrance. What changed was the story people believed about them. Today, that same phenomenon is unfolding again, except this time, it's not tulips. It's everything. The current bubble didn't begin with a single event. It began in March 2020, when the global economy locked down. Governments panicked. Central banks responded with the largest monetary intervention in human history. The Federal Reserve expanded its balance sheet by $4.7 trillion in 18 months. The European Central Bank added $3 trillion. The Bank of Japan, another $2 trillion. China pumped trillions more into its system through bank lending. All that money had to go somewhere. It flooded into financial markets. Stock indices doubled. Real estate prices surged 40% in some cities. Cryptocurrency values exploded by factors of 10, 20, even 50. A digital image of a cartoon ape sold for millions of dollars. But something else happened that most analysts overlooked. The composition of market participants changed entirely. In 2019, retail investors, individual people trading from their phones and computers, accounted for roughly 10% of market volume. By 2021, that number exceeded 40%. Millions of people who had never owned a stock suddenly became day traders. They weren't investing. They were speculating. And they were doing it with borrowed money, margin debt. The amount investors borrow to buy stocks reached $850 billion in 2021. That's nearly triple the level before the 2008 crash. But the real danger lies in where that debt is concentrated. Young investors, mostly under 35, account for the majority of this borrowing. Many of them have never experienced a bear market. They entered investing during a period when stocks only went up, when buying any dip was rewarded, when holding was the only strategy that mattered. They learned a pattern. But they learned it in an environment that was artificial, unsustainable. Consider the mechanism that created this illusion. When central banks suppress interest rates to zero, they destroy the return on safe assets. Savings accounts pay nothing. Government bonds yield almost nothing. Retirees and pension funds, desperate for income, are forced into riskier assets. This creates artificial demand, not demand based on company fundamentals or economic growth. Demand based purely on the absence of alternatives. Insurance companies bought stocks because bonds paid nothing. Pension funds increased equity allocations because they needed 7% returns to meet obligations. Individual investors piled into markets because keeping money in banks meant watching it lose value to inflation. None of this demand reflected genuine economic optimism. It reflected financial repression. And the companies? They responded rationally to these conditions. Corporate America borrowed trillions at near zero rates. But they didn't use that money to build factories or hire workers or develop new products. They used it to buy back their own stock. Stock buybacks reached record levels, over $5 trillion in the past 5 years. When a company buys its own shares, it reduces the number of shares outstanding. This makes earnings per share appear higher, even if actual profits don't grow. It's financial engineering, a magic trick. It makes valuation metrics look better without creating any real economic value. Meanwhile, profit margins expanded to all-time highs, not because companies became more efficient, not because they created better products, but because they had pricing power in an economy flooded with cheap money and government stimulus checks. Consumers spent freely because their stock portfolios were rising, their home values were increasing, they felt wealthy, so they paid higher prices without complaint. This is called the wealth effect, and it's entirely circular. Asset prices rise, people feel rich, they spend more, corporate profits increase, stock prices rise further. The cycle feeds itself, but only as long as asset prices keep climbing. The moment they stop, the entire mechanism reverses. Now look at the current situation through this lens. Interest rates have risen from 0 to 5%. That destroys the economic justification for extreme valuations. It makes bonds competitive with stocks again. It increases borrowing costs for companies that became addicted to cheap debt. Corporate profit margins are compressing. Input costs are rising. Labor costs are rising. Consumers are exhausting their savings. Credit card debt has reached record levels. The circular mechanism that inflated this bubble is breaking down. And the shooting star that appeared today, it's the market recognizing this reality before the consensus does. In 1636, tulip buyers were rational until they weren't. In 2000, tech investors were rational until they weren't. In 2007, real estate investors were rational until they weren't. The pattern repeats because human psychology doesn't change. We believe stories. We follow crowds. We assume recent trends will continue forever until they don't. There's a game that engineers play when testing structures. They call it stress testing. They don't test one thing at a time. They apply multiple forces simultaneously. Wind from the east, weight from above, vibration from below, heat expansion, cold contraction, all at once. Because in the real world, bridges don't collapse from a single force. They collapse when multiple stresses converge at the exact same moment. The financial system works the same way. And right now, 5 separate stress points are converging. Each one alone would be manageable. Together, they create something far more dangerous. Let's start with the one nobody wants to discuss. In 2008, the United States government debt stood at $10 trillion. Today, it exceeds $34 trillion. In 15 years, the debt tripled. But here's what makes this different from previous debt expansions: the interest payments. When debt was $10 trillion and interest rates were 3%, the government paid $300 billion annually in interest. Manageable. But now, debt is $34 trillion and rates are 5%. That's $1.7 trillion in annual interest payments. To put that in perspective, it's more than the entire defense budget, more than Medicare, more than Social Security. The government now spends more money paying interest on old debt than it spends on almost any actual government program, and it gets worse. Roughly 30% of government debt matures within the next 12 months. That means it must be refinanced. Old bonds paying 2% will be replaced with new bonds paying 5%. Every $1 trillion refinanced adds $30 billion in annual interest costs. This creates a trap, a debt spiral. The government must borrow more just to pay interest on existing debt. And that borrowing pushes rates higher, which increases future interest costs further. Japan entered this trap in the 1990s. They never escaped. Their economy hasn't grown in real terms for 30 years. Now the United States faces the same trajectory. In Europe, in China. But that's just the first stress point. The second is hiding inside the banking system. In March 2023, Silicon Valley Bank collapsed in 48 hours. It was the second largest bank failure in American history. The trigger? Rising interest rates. Here's how it worked. Banks hold government bonds as safe assets. When interest rates were 0, those bonds were worth their full face value. But when rates rose to 5%, the value of old bonds paying 2% collapsed. Silicon Valley Bank held billions in these bonds. On paper, they showed no losses because accounting rules allowed them to pretend the bonds were worth full value. But when depositors started withdrawing money, the bank had to sell the bonds at their real market value. The losses were catastrophic. The bank failed. Silicon Valley Bank wasn't unique. Analysis shows that over 200 American banks currently hold similar unrealized losses. Combined, these losses exceed $600 billion. These banks haven't failed yet because depositors haven't panicked yet. But the losses exist. They're sitting there, hidden in balance sheets, waiting for a trigger. The shooting star could be that trigger. If markets decline sharply, depositors get nervous. They withdraw funds. Banks are forced to sell assets at losses. More banks fail. Confidence evaporates. The cycle accelerates. This is the third stress point. Confidence. Financial systems run on belief. People deposit money in banks because they believe the money is safe. Investors buy stocks because they believe prices will rise. Companies borrow money because they believe they can repay it. But belief is fragile. It can vanish in moments. In 2008, Lehman Brothers was a 150-year-old institution. On a Friday, its stock traded at $40. By Monday, the company was bankrupt. What changed? Nothing fundamental changed. What changed was belief. Today, belief is sustained by one thing: the assumption that central banks will intervene, that governments will provide stimulus, that authorities won't allow a major crash. But here's the problem. Central banks have already expanded their balance sheets to unprecedented levels. Government debt is already unsustainable. Inflation is already elevated. The tools that worked in 2008 and 2020 can't be used again without destroying currency credibility. The authorities know this. They won't admit it publicly, but they know. And sophisticated investors know they know. This is the fourth stress point: the absence of a backstop. Now add the fifth element: geopolitics. Supply chains are fragmenting. The globalization that defined the past 30 years is reversing. Countries are choosing security over efficiency, reshoring over offshoring, allies over lowest cost producers. This makes everything more expensive. Manufacturing, energy, food, technology. The deflationary forces that kept prices low for decades are disappearing. At the same time, geopolitical tensions are rising. Trade wars, actual wars, sanctions, export controls. Each conflict reduces global economic cooperation and increases costs. Companies that optimized for a world of free trade and stable borders now face a world of barriers and uncertainty. Their profit margins reflect the old world. Their costs reflect the new one. The adjustment will be painful. Now step back and see how these 5 forces interact. Rising interest rates stress government budgets, which limits fiscal stimulus, which removes a key support for markets. Banking system fragility increases, which tightens credit, which slows economic growth. Loss of confidence accelerates, which triggers asset sales, which stresses banks further. Geopolitical fragmentation raises costs, which compresses profit margins, which disappoints investors. Each stress amplifies the others. The engineer's nightmare scenario, multiple forces converging simultaneously. And throughout history, this convergence has one consistent outcome. In 1929, it wasn't just stock overvaluation. It was also banking fragility, gold standard constraints, and trade wars. The combination created the Great Depression. In 2008, it wasn't just subprime mortgages. It was also excessive leverage, banking interconnection, and regulatory failure. The combination created the Great Recession. Today, the combination is different, but the principle is identical. Multiple systemic weaknesses activating at once. The shooting star that appeared today isn't predicting this convergence. It's reflecting it. Market price action is aggregate intelligence. Millions of participants processing trillions of data points. When that collective intelligence forms a shooting star at the peak of a bubble, during a moment of maximum systemic stress, history suggests one response: preparation. Because what's coming isn't just a correction, it's a restructuring, a reset, the kind of event that redefines what people thought was possible. The question is no longer whether these stresses will converge. They already are converging, right now. The question is, what does someone do about it? December 1999. A fund manager named Mark sat in his Boston office reviewing his portfolio. Everything he owned had doubled in value. His clients were ecstatic. His bonus would be record-breaking. But something bothered him. The valuations made no sense anymore. Companies with zero revenue traded at billion-dollar market caps. The word profit had become irrelevant. Only growth mattered. Only the story mattered. Mark made a decision. He sold 30% of his technology holdings. He moved the cash into boring stocks, utilities, consumer staples, companies that actually made money. His clients were furious. His boss questioned his judgment. For 3 months, he watched the market surge another 20% without him. Then March arrived. The Nasdaq collapsed 50% in 8 weeks. Mark's boring stocks held steady. His portfolio declined only 12%, while competitors lost 40, 50, even 60%. By 2002, Mark's fund had outperformed 97% of the industry. Not because he predicted the exact top, not because he timed the crash perfectly, but because he acted when the risk-reward equation became unfavorable. That's the framework that matters now. Strategic response isn't about prediction, it's about probability. It's about recognizing when the downside potential significantly exceeds the upside potential and adjusting accordingly. Right now, that equation is crystal clear. If markets continue rising, the potential gain is perhaps another 10 to 15% before fundamental constraints force a reversal. But if the shooting star signal proves accurate, the potential decline is 30 to 50%, based on historical valuation, mean reversion. Risk 15% to potentially gain 10%, or protect capital and wait for better opportunities. The mathematics are obvious. So what does a strategic response look like in practical terms? First, understand the phases of bubble deflation. They follow a pattern. Phase 1 is denial. Prices decline slightly. Investors call it a healthy correction. Buy the dip mentality dominates. This phase typically lasts 2 to 4 weeks. Phase 2 is recognition. The decline accelerates. Volatility spikes. Media coverage shifts from optimism to concern. Investors begin questioning their assumptions. This phase lasts 1 to 3 months. Phase 3 is capitulation. Panic selling. Forced liquidations. Margin calls trigger automatic selling. This phase is violent but brief. Days to weeks. Phase 4 is stabilization. Prices find a bottom. Real value investors begin buying quality assets at discounted prices. This phase can last months or years. Most people wait until phase 3 to act. By then, the damage is done. The strategic response must happen now. During phase 1, before consensus recognition, here's the practical implementation. For investment portfolios, reduction of equity exposure is primary, not complete elimination, but meaningful reduction. moving from 80% stocks to 50% stocks, from 100% invested to 70% invested. The cash raised serves two purposes. It protects against downside, and it provides ammunition to buy quality assets when they inevitably become cheap. Think of it as insurance. You pay a premium, the opportunity cost of missing potential gains, to protect against catastrophic loss. Within remaining equity positions, quality matters more than ever. Companies with strong balance sheets, low debt, consistent cash flow, pricing power. These businesses survive downturns and often emerge stronger. Speculation must end immediately. Meme stocks, cryptocurrencies, unprofitable technology companies, options trading. These are the tulip bulbs of this era. They will be the first and hardest casualties. For business operators, the framework shifts to defense and flexibility. Cash becomes the most valuable asset. Credit lines should be secured now while banks are still willing to lend. Inventory should be reduced. Fixed costs should be converted to variable costs wherever possible. This isn't pessimism, it's prudence. Companies that enter recessions with strong cash positions and flexible cost structures are the ones that acquire competitors, gain market share, and emerge dominant. Consider Amazon in 2008. While competitors struggled with debt and fixed costs, Amazon had billions in cash. They invested through the downturn. They acquired technology. They hired talent. By 2010, they had increased their market dominance substantially. Preparation creates opportunity. For individual professionals, the priority is income security and skill development. In contracting economies, specialized skills become more valuable. Generic skills become commoditized. Side income streams provide buffer. Reduced personal leverage, paying down credit cards, avoiding new debt, creates flexibility. Emergency funds covering 6 to 12 months of expenses provide psychological stability. When others panic, prepared individuals can act rationally. They can negotiate better job offers, start businesses that serve new needs, invest in assets that others are forced to sell. The timeline for implementing these strategies is narrow, not because collapse is imminent, but because by the time everyone recognizes the need, it's too late. Banks tighten lending overnight. Asset prices gap down before you can sell. Opportunities for strategic positioning vanish. So the question becomes very simple. Do you trust the shooting star? Do you trust the convergence of systemic stresses? Do you trust the historical pattern that has repeated across centuries? Or do you trust the crowd? The analysts on television saying everything is fine? The momentum that has worked for the past 2 years? Michael in 2000 trusted the signal. He acted early. He preserved capital. He thrived in the aftermath. Sarah in 2008 trusted the signal. She reduced exposure. She protected her fund. She outperformed when it mattered most. The shooting star has appeared again. The bubble's anatomy is clear. The systemic stresses are converging. The risk-reward equation is unmistakable. What happens next depends entirely on one variable: who acts now and who waits for confirmation that comes too late. The market has spoken. In the language of candlesticks, in the vocabulary of price action, in the syntax of collective intelligence, it said, warning. The only question left is, who's listening